gentlemen, with that, as you've noticed, we're going back to back with all the sessions. Let's also keep that momentum on, and let's now move on to our next session coming your way, which has got to do with reimagining modern finance. And as we talk about it, who better than a very renowned Mr. Bill Winters, Group CEO, Standard Chartered, who will be sharing his thoughts around this very pertinent topic. And ladies and gentlemen, as we all know, that while he's the Group Chief Executive of Standard Chartered since June 2015, we also know that Standard Chartered is a UK headquartered emerging markets focused bank employing more than 85,000 people with presence in 59 markets across Asia, Africa, and Middle East. And he is the leading voice on sustainability. And he's also the non-executive director of Novartis International. And ladies and gentlemen, it'll only be befitting to get this leading voice on sustainability to also share his thoughts around the very, very important bit of reimagining modern finance. Now, let me tell you, the one person who will also be in conversation to gather as many insights as possible, we're going to have once again Arijit Barman, who is the Deputy Resident Editor of The Economic Times. So it's time to reimagine. Well, then it's time to deep dive into this conversation.
Thank you very much for that introduction. Today, we're going to talk about a very hot topic, banking in digital age. For that, I'm going to pick the brains of William Thomas Winters, or Bill Winters, CEO, Standard Chartered Bank. Mr. Winters, thank you for taking time out and talking to the Economic Times Global Business Summit.
Arijit, my pleasure to be here.
Before I get into the big macro picture and the broad trends, I want to understand how technology is reshaping Standard Chartered and the bank's way of existence.
Yeah, it's right at the core, as you would imagine, and in many ways, I think I expect other bank CEOs think of themselves as running technology companies as much as we're running finance companies. Mm-hmm. Both strands are important, but it takes a lot of forms. There's the whole legacy body of business that we do, which needs to digitize quickly. So the way that we interact with our customers, the way that we process transactions ourselves in our organization needs to be automated and digitized because that's what our customers expect. But then there's the whole block of new stuff, whether those are neobanks or new ways of delivering credit to customers, perhaps in partnership with technology companies. So it's a tech proposition, a tech offering, but still at the core, a set of banking products. Mm-hmm. And making sure that we both have the skills and the understanding and the ways to deliver that technology in a human way, so that, mm-hmm. that our customers and our clients, while they're using whatever the latest technologies we can come up with, know that they're still dealing with Standard Chartered Bank, that behind Standard Chartered Bank, there are human beings who have a purpose and a mission and who are driven to succeed. So but technology is right at the heart of everything that we're doing.
Mm-hmm. And would you say that COVID actually, or 2 years of pandemic lockdowns in between, actually accelerated this process? I mean, how did, in your experience, your bank hold up during this entire period of flux?
So I've been extremely impressed by what my colleagues have been able to deliver, and about 30,000 of them are in India, both in terms of our banking business, but also our whole technology and operations area, which is headquartered across various cities in India. Mm-hmm. And the great news is that we fared very well during the pandemic. We were able to maintain our transaction flows without any interruption whatsoever. Of course, what we also saw was a dramatic shift by our clients into online channels, mm-hmm. for all the obvious reasons, and that tested the competence and the bandwidth of everyone in the financial services sector, because we had many times the volume going through these digital channels that we had before. And the trend was very clear anyway. We were well on the way to processing 70, 80, 90, 99% in the case of some of our businesses digitally already, but the pandemic definitely accelerated that. It was a real life test for the underlying robustness and resilience of our infrastructure. I'm happy to say that we passed the test.
Mm-hmm. And let's now shift a little bit from beyond Standard Chartered into something that's been happening and bothering a lot of perhaps CEOs like you who run banks, is that big tech is making a big foray in financial services. We've seen Amazon get into payments. We've seen Google test first in India, and then they're taking the Google the payments products across the world. How do you see this onslaught of big tech into banking and the larger financial services play per se?
Yeah, I think it's an excellent question, and it takes on many different tones, I think. We know that what customers want is convenience, especially for standardized day-to-day banking products. They want convenience. And if they can get that convenience by operating on a platform that they're already using very actively, whether it's a social media platform or a search platform or a messaging platform or a payments platform, to the extent that that's where they want to take and acquire some additional financial services, somebody's going to make it easy for them to do that. And that, I think we should recognize that where the customer's desire for convenience is best met on some existing platform, it will be our job to make sure that the products that they acquire through that platform are best in class, that we can hold our own. And the approach that we've taken in terms of working together with some of the big tech companies is to be their partner. I mean, we're rolling out right now a platform in Indonesia where we partnered with Bukalapak, the largest e-commerce network in the country. And we're delivering a full range of banking products completely seamlessly through that convenience platform. If you take out a loan, if you make a deposit, you're going to be a Standard Chartered customer, but you're going to have all the convenience that you've become accustomed to in working with Bukalapak or Sosiala, which will follow quickly on the heels of the partnership with Bukalapak. And these partnerships take different forms in different markets. With Ant Financial and Jingdong or JD.com in China, we've got a different sort of partnership. As we go into the partnerships we've got with the mobile companies in Africa, different again. So I think our mission is to make sure that we can deliver best-in-class products into convenience platforms. But we have other missions as well, and that's to create some platforms of our own. So we're extremely proud, for example, of something that we set up in India called Solve. Solve is a platform that allows SMEs to interact with each other, with their suppliers, with financial services providers, with professional services firms. Now we've got well over 100,000 customers now and growing very, very fast. We've rolled out that platform in Kenya. We'll roll out in other markets soon. So this is a platform that we've created ourselves. This is the convenience platform for that client sector. And to the extent that we can work with others to bring ever more products and services and quality to those small and medium-sized enterprises, super, we'll do that. But we can partner with other platforms. We can create our own platforms. And then lots of people still like to deal with a human being, especially things that are important in their lives. Managing their wealth, thinking about how they're funding their children's education, thinking about healthcare throughout your life, but in particular later in life, and the facilities that you want to make sure you can draw on. And for those sorts of critical human interactions, the key for us is to make sure that our clients have all the access to digital and automated tools that they would find convenient, but without losing anything in terms of the human interaction, the advice that comes with a human relationship. So lots of different ways to skin the cat. In some cases, we are competing with tech companies, but more often we're partnering with them or just going our separate ways because we've got very different propositions.
But the lines are clearly blurring, right? Between a technology company and a retail company and a social commerce or a media company and a financial services. Everyone seems to be doing everything.
Yeah, but lines are blurring. But I think there's a few things that, at least so far, have been a given. One is that the tech companies don't really want to be in capital-intensive businesses. What we've seen is the tech companies, for the time being, are trading at phenomenal multiples of anything, multiples of earnings, multiple of income, multiple of equity value. And the last thing that they want to do is to bog down their balance sheet with very capital-intensive businesses like lending, or take on lots of operational risk that requires them to hold extraordinary amounts of capital. That's number one. Number two is very few technology companies want to be regulated like a bank. I can tell you, being regulated like a bank is a very, very heavy burden. It's a price that we pay so that we have access to deposits and that we have access to central bank liquidity in times of stress, et cetera. So, for us in the banking world, we've made that deal a long time ago. We have the privileges of being a bank, in exchange for which we have the regulation and the controls around being a bank. Mm-hmm. I've come across very few tech companies that are prepared to subject themselves, or for that matter, who are capable of delivering on the regulatory obligations that come along with some of these products. So the lines are blurring, but there are some lines that really still haven't been crossed.
Mm-hmm. Would you be open to, say, partnering with any of these so-called fintech companies, and maybe even look at acquisitions together? Or maybe just acquire platforms which are purely fintech platforms?
We have hundreds of fintech partners. We've made investments either into the fintech company itself, or investments into a combined partnership in dozens of cases. So the most recent partnership that we've entered into, which involves Standard Chartered making an equity investment into a company called Neuron Credit, which is part of the Advanced AI Group, a Pan-Asian consumer credit product provider. So we made an investment in the company, but we also have a very deep-rooted partnership across 11 markets where we can deliver the banking services on the back of the credit origination capabilities that the Advanced AI and Atome Neuron Credit on the back of that undertaking. So it's that kind of, every partnership is different, and every equity investment that we make is different. But we love it when we can help to establish the success of a fintech player, and that we can do that through our partnership with Standard Chartered Bank.
Correct.
But at the same time, we can help promote their growth by taking an equity investment in the company itself. So, like I say, each one is a different format. There's no formula, but exactly the kind of partnership that you're talking about, we're doing over and over and over again. And if I could say, I think Standard Chartered is a very desirable partner. And I asked why. Whenever we get into a partnership, I ask the principal, why do you want to work with Standard Chartered? And they almost always say the same thing. One is, you're very good technologically. You can match us in terms of technological prowess, and you can connect technology to technology. Second is you're quite agile, that you can move quickly. And third is you're big enough to be very, very relevant in pretty much everything that you do, but you're not so big that you lose your agility, and you're small enough that you're prepared to be a disruptor. So you're prepared to go in and disrupt a market. And I think I'm always happy when I hear that, because I think it's correct that we do have technical skills. We are prepared to disrupt, and we can add real value to a tech partner, whether it's a fintech or a big tech.
Just like your favorite football club, I guess. Now,
well noted.
On a serious note, do you feel that the first level of disruption will actually take place in retail banking? Because that seems to be the first thing that many of these fintech or neobanks are looking to disrupt.
Yeah, absolutely. And even more specifically than retail banking, the initial disruptions really came in the payment space. So it's expensive. It was expensive and cumbersome to make small value payments domestically, and then very expensive in some cases to make payments cross-border. And fintech companies stole a march on the banks and stole a march on the credit card companies, the payment platforms, Visa, MasterCard, et cetera, by offering convenience at a more reasonable price. Now, of course, the banking industry has subsequently met that and is now embedding those payment platforms into the broader offerings that banks have always delivered to our clients. But I think, and we're going back 10 plus years in this case, it was a great wake-up call for the banks to say you should not take anything for granted. You must wake up every morning thinking about how you can deliver a better quality product and a better set of services to your customers, or else somebody else is going to do it for you. And back to one of the earlier discussions that we just had, the payments business isn't capital intensive. It's operational intensive, it's technology intensive. But that fits quite well outside of the conventional confines of banking. Yeah, there will be plenty of disruption in retail. But I think you're seeing that the good old banks like Standard Chartered are continuing to do very well because we can match the technology. Sometimes we can be innovative ahead of the fintech companies or ahead of the big tech companies. That's what we aspire to all the time. But at the same time, we can maintain that trust, the strength, the stability, and the human relationships that so many of our customers value.
Now, the moment we talk about customers, the issue of privacy, the issue of data comes into play. And that's also becoming a big concern for the regulators, even for sovereigns. Do you feel, or rather, what trends are you seeing in terms of the regulatory landscape when it comes to monitoring and controlling the data flow?
I think there are some really good trends, and I think there are some not so good trends. Amongst the good trends, I think, are just a general requirement that we be extremely aware about the valuable data that we possess that comes from our clients, and that we take every reasonable step to protect that. And I think banks have been very strong custodians of our customers' wealth from the beginning of time. And when we don't act in the interest of our clients in terms of helping them manage their savings, their wealth, the repercussions are quite severe. So banks, I think, are quite good at that. We have to be every bit as good at helping our customers manage their data and play our role in protecting their data, because that's in many cases as valuable as their wealth. So, and I think that trend of constant focus, pressure from regulators, pressure from consumer advocacy groups, and maybe most importantly, pressure from ourselves to live up to our very high standards around data protection is key. In terms of, I think, less helpful trends, we're seeing instances around the world of regulators who are saying, we want to make sure that you keep all of your local customer data onshore. So it can't go into the cloud. It can't go into your central database that could be sitting in a country outside of the home country. So that sort of fragmentation of underlying data infrastructure is very expensive. It actually, in many cases, can lead to a lower quality of service. So we'll invest very heavily into our central systems to protect our customers' data. And to the extent that we're using a cloud service provider, Azure or AWS, somebody like that, they're also investing very heavily to make sure that data is protected. When we have to pull together a separate operation that's local, that's perhaps is not allowed to go into a cloud service, even a local cloud service, there's a risk that the security is actually less good than what we have in the global construct. So these trends towards local or regional segregation of data, I think, are quite unhelpful, but nevertheless are happening. And you can understand it at a high level. This is data of my citizens. I want it to stay onshore. But actually, I think you're doing both the citizens and the banks a disservice with that sort of policy.
Just the last question, because we are running out of time. How are you planning to leverage digital solutions to deliver on your retail strategy? Any particular theme that stands out?
Yeah, we made commitments to our shareholders to deliver a substantial increase in the number of customers that we serve. I think we're saying we can double the number of customers that we're serving in 3 years. That can only happen by delivering our products and services digitally. And digitally with pretty much complete straight-through processing. So no human intervention on at least 95% of the transactions that are going through. And to the extent that we can deliver that in terms of customer service and scale, it will also be cheaper in the long run for us. In the short run, it's expensive because you have to invest in order to generate those capabilities. But our key drivers for our retail business are digitize everything end to end. It's what our customers expect. It's how you get the highest quality of service, to generate savings along the way as we're doing that, and to always retain the human interaction, the advice engines that have human beings at the core, but to deliver those in the most convenient possible way, which in many cases will be digital.
Mhm. The last question from me, and I have to ask you, since we're talking about the digital age and banking, most bankers like you have scoffed at the idea of a digital currency. Where do you stand?
Well, thankfully, I've never scoffed at the idea of a digital currency. I think there is a lot of opportunity to deploy digital currencies in a really helpful and effective way. And so of course, there are many types of digital currency. There's the central bank digital currencies. I said the one that's got the most traction at this point is the
Crypto.
Well, I would say in terms of central bank digital currencies, would be the Chinese digital currency. There are many others that are in different stages of development. I think for a central bank, you've got to be very clear what's the use case. Why do customers need? Why do citizens need this central bank digital currency? And I don't think every central banker has answered that question adequately. The Chinese, I think, have done the most complete job. There's stable coins, which are, I think, becoming an extremely important medium for exchange in the digital economy. And that's, as the whole world of decentralized finance, the online economy becomes a bigger and bigger part of our lives. And certainly when we talk about decentralized finance, it's still small, although it's grown from $1 billion a year ago to $200 billion today. So incredibly rapid growth that could become impactful down the road. And digital currencies, in particular stablecoins, are a critical part of that. And then for the non-fiat based cryptocurrencies like Bitcoin or Ethereum, I think we're seeing substantial interest from institutional investors to hold this as an asset class. It's a different. It doesn't track an underlying currency. It may provide some sort of a hedge against inflation or economic shock. So I think there's a role for these other cryptocurrencies. We're seeing interest in that. I don't think in and of itself they're transformational, but the combination of the digital economy, cryptocurrencies, stable coins, central bank digital currencies, and then the full range of other tokenized assets. We've heard all about artwork which has been tokenized and sold for tremendous amounts of money. And time will tell how enduring some of these trends are. But the fact is there's a digital ecosystem that's being built that's very powerful, and all of us should be understanding it, doing what we can to make sure that that business on these platforms is conducted safely and soundly, and obviously driving for a convenience vis-a-vis our customers.
Very exciting times indeed. Thank you once again, Mr. Winters, for taking your time out and talking to us. Hope to see you in person very soon. Thank you.
Look forward to it. Thank you, Arijit.